Good.
The light comes on.
Good afternoon, everyone. I'd like to welcome everyone here this afternoon. I make the time 3 p.m. It is our July 10th council meeting, and as most of you are aware, this is our last council get-together before summer break. We are rescheduled, Andrew, I believe, Tuesday, August the 21st, the third Tuesday in August. Is that fair? Yeah. Thank you, Andrew.
Through you, Mr. Mayor, somewhat more complicated. AMO's that week, so it would be the Thursday. However, if there is a lame duck council, then we won't meet that week. We'll meet the following Tuesday.
So you're suggesting the 23rd. Thank you very much for that. I wasn't aware. Okay. You notice there's a few empty seats here at the moment. Councillor Sonnenberg will not be with us this evening. He is away on personal business. Councillor Wells will also be absent this evening. He is away on personal business, a lot of personal business today. Councillor Columbus is away and will be joining us hopefully before 4:30. He too is on personal business. But the most important thing is the rest of us are here and we have a quorum to do today's business. Again, housekeeping, our meeting this afternoon is, as always, web streamed and televised. If you have a cell phone or something of that nature and it's on silence mode, we really like that, so our meeting is not disrupted. There are two changes. Item 1, we have no ceremonial activities, but item 2, there are two changes that are proposed to the agenda tonight. There is one of these is the addition of a minor appointment bylaw under the Clean Water Act that will be added. You can see it on your sheet here, item B, that we add bylaw 2018-81 to our bylaw package. And the other change to the agenda deals with DCS 1874. That's a staff report that you'll find on page 127. That should not be at our 5 o'clock public hearing. That should be a staff report. It is being proposed to become 12C item. So those are the two changes. The bylaw to be added is attached to the changes to the agenda. Andrew, thank you for all this extra work to make this meeting go a little smoother. So, is there anything else before I read the motion? Councillor Height, please, and thank you.
Thank you, Mayor Luke. Under our closed session item, we have a DCS memo, bylaw enforcement matter, and it's saying the reason is that there's identifiable individuals or solicitor-client privilege, and I'm wondering why it's in closed session. I read the report. I didn't feel that it needed to be in closed session. I don't think there's anything in there that should make us go into secret session.
And which one is that again? We have 4 items.
It's item B under closed session, DCS memo, bylaw enforcement matter.
Bylaw enforcement matter. Update of the county medical building, Hastings Drive enforcement, annual performance review, and we also have an employee-related matter. Which one of those?
Hastings Drive enforcement.
Hastings Drive enforcement. Mr. CAO, do you wish to comment on the question why that is in closed session? Thank you. Thank you, Councillor Height. We'll get a response.
I can't give a properly fulsome response to your question because we are in open. I can give you an entirely fulsome response if you choose to ask that question while we're in closed. And of course, council then can consider and have a vote on whether or not it wishes to remain enclosed or not. We are in compliance with the law in that what it says on the open session is all we need to say to have adequate reasons to go in closed session, assuming them to be true. To slightly expand, though, and to offer some degree of comfort, it is entirely, 100%, utterly inappropriate and irresponsible, law enforcement 101, not to announce specific steps that are about to be taken in the context of law enforcement. The police do not say, we are going to raid your clubhouse tomorrow, for very good reasons. Taking that extreme example back to the municipal bylaw enforcement world, there are more than adequate and appropriate reasons, from staff health and safety to the maintaining the integrity of an investigation, that we would provide the information in closed session. I would provide a more specific, less generalist answer were the question to be asked again in closed session, but for now, it is the opinion of the county solicitor and the opinion of myself that this is appropriately on the closed session agenda. Council has the right to vary that opinion, and we will always, of course, comply, but on the face of it, it is appropriate.
Okay.
Councillor Haight, certainly you would be in order to, at the onset of that closed session, raise your question. Okay, and then we can go from there. Okay, thank you, sir. Any other changes or questions of tonight's agenda? Moved by Councillor Oliver, seconded by Councillor Geisens. That staff report DCS 1874 respecting lakeshore and riverine flood hazard study be moved from the public hearing section of the agenda, placed on staff reports identified as item 12C, and B, that the agenda be amended through the addition of bylaw 2018-81 being a bylaw to amend bylaw 2016-78 for appointment of risk management official and risk management inspector for the purpose of the Clean Water Act 2006. Any discussion on those two changes to the agenda? Hearing none, I'll call the question. Those in favor? That is carried. Thank you, gentlemen. Is there any disclosure of pecuniary interest to be declared this evening? I hear none. There are no consent items. We have one presentation this evening. I see Mr. O'Donnell is with us. I'll get to you in a moment, Jeff, if you will, please. So we will be having a presentation from Mr. O'Donnell. However, just before I call him to that microphone, I would turn things over to our county CAO, Mr. Cribbs, and Ms. Fanning is here. James, I don't know if you wish to speak, but I'll just send it over to staff over here to make their comments. Mr. Johnson, thank you.
Thank you, Mr. Mayor. Mr. Mayor and members of council, I'm just going to do a brief introduction and hand it over to Amy Fanning. All departments, divisions, and most of Financial Services Division had their fingerprints on some numbers along the way to reach this end product we call the consolidated financial statements. However, the two employees to my right were instrumental in this process. Amy Fanning, to my immediate right, Deputy Treasurer, and then to my far right, Megan Souls, who's a CPA that came to us from Taylor Lebo, Chartered Professional Accountants. Both, again, has been very instrumental in bringing this report and the financial statements to you today. As Amy will state in her introduction, this report has been redesigned from the ground up and has been taken some noteworthy strides to provide more meaningful information to Council. And with that being said, I'd like to turn it over to Amy to introduce Report FS 1828, the annual audited financial statements and performance measures for 2017.
Thank you, James. Through Mayor Luke to the members of council, I just want to touch briefly on some of the changes that we did make to this report versus the previous year's reports that council's seen. I know that prior year's reports contained a lot more description and detail on each of the statements and each of the categories therein, and that's been the same way for the past few years. So now that we believe council's received that information and is comfortable with the format that the reports are in, I've really tried to summarize that in this year's report and to make that piece of the report shorter so that we can focus more on the details and the analysis and the reconciliation of the PSAP information to our operating information. So I'm just going to highlight some of the tables in the report as we go through. On page 6 of the report, which is page 12 of your agenda package, we have table number 1, and this is similar to a table that council received in last year's report. It's highlighting the major tangible capital asset additions to our TCA total for 2017. Table 2 is new, and this is not one that will be carried forward, so this will be the only time that you'll see a table similar to table 2, and this came about based on some in-depth discussions and some analysis that financial services staff have done in conjunction with Millard's. And what we discovered was that the water and wastewater debt repayments were being categorized and grouped together with all other debt payments and were being applied to our contingency reserve instead of the appropriate water or wastewater capital replacement reserve. So we've corrected that item and we're just doing a restatement in table 2. So that will show you the change that was made to the opening balances of those individual reserves and reserve funds, and they'll reconcile to note 10 of the financial statements. So moving forward to table number 3, which is page 8 of the report or page 14 in your agenda package. Again, this is a report that council did see in last year's report. But we have regrouped and changed some of the groupings just to try to make some of the numbers a little bit more easy to follow. But what this does is takes the $1.1 million surplus that's shown on the income statement or the consolidated statement of operations, and it reconciles it down to the $5.6 million operating deficit, which is shown in Note 10 from the financial statements. And there's a number of changes that need to be made in order to take the Public Sector Accounting Board or PSAB standard reporting format and display that so that it matches the operating format that Council's used to seeing in the budget documents. So if we follow that $5.6 million deficit to the next page, on Table 4, you'll see we've taken the budget from the income statement and made some adjustments to it in order to reflect the $0 levy budget that Council approves in January of each year. And then you'll see the actuals and the variance, which again ties down to that $5.6 million from Note 10. So if you're looking at the budget column, you'll notice it doesn't match the income statement, and that's because we've removed the water wastewater budget and we've also removed amortization in order to bring it back to the numbers that Council's used to seeing. But we've kept it categorized in the same way that our financial statements are categorized, just to try and tie those two pieces of information together. So you'll see that there are some non-PSAB budget items at the bottom of that table, and I do apologize to Council. The third item down, the $5,372,872, excuse me. We were so concerned about the numbers and cross-referencing them multiple times that we missed a label. So that should read transfer to obligatory reserve funds, and again, I do apologize for that slip. The two biggest item variances that I want to highlight in this table are the general government budget to actual. So Council will recall Report FS 1832, where we approved the write-off of $2.1 million. That write-off shows up in that amount, so that's a big driver for that variance. There's also the increase in the employee benefits liability for the year in there, and the budget amendments also show up in that item. So there's several items driving that increase. On the next table, Table 5, which is page 10 of the report, or page 16 of your package, this list includes all of the budget variances, plus or minus $100,000 or more. And then at the bottom, you'll see $824,296, which is the other sundry miscellaneous items which we've grouped together. But all of the variances that are $100,000 plus or minus are called out individually for your review. On page 12 of the report, or page 18 of your agenda package, table number 6, the Norfolk County Financial Sustainability Performance Indicators. These indicators were passed in a report by Council in 2009 and again reported to Council in 2011. And unfortunately, they haven't been reported since, but we're bringing them to your attention now. And I want to highlight a couple of things in this table for Council's consideration. One is that the first column, the target column, we haven't changed those numbers from the way that they were presented in 2009. Which means we haven't made any adjustments for inflation or for consumer price index information, population changes, any of those considerations. So all of those targets are presented as they were established. And what we'd like to suggest is that financial services staff take these back and review them and do some more research on those targets and on what appropriate levels for today's business needs are, and bring that back to Council in early of 2019 for your recommendation. The only changes that were made to this table were for reserves per household, total reserves as a percentage of total expenditures, and debt to reserve ratio. So what we did for each of those indicators was to list them as a total and then list them again excluding the legacy fund. So you can see that our balance on each of those three indicators declines sharply when we remove the legacy fund from that item. So table 7 is the next one I'm going to talk about, which is page 14 of the report, or page 20 of your agenda package. And Council has seen the same table many times before. The only change this year is the restatement for 2016. As described in the report, we had to restate some numbers based on an actuarial review that was done and based on the discovery of the water wastewater debt repayment change. So we've restated the accumulated net surplus column for 2016 and then updated for 2017. As council, I'm sure, has noticed, our long-term liabilities, which is essentially our debt, has doubled since 2009, and our reserve fund balance has been cut in half or just below that number since 2009. If this trend continues, it will impact our financial sustainability and our credit rating going forward. So staff are recommending that the operating deficit be funded from the contingency reserve, and if council approves that recommendation as it is in the report, that will leave approximately $1.5 million in our contingency reserve. It's important to note that Section 290 of the Municipal Act states that a budget for a year must include deficits of the prior year if they cannot be funded from a reserve, retirement, or sinking fund. So if we were to have a deficit in excess of that, we may need to levy for it in a future year. So financial services staff have done a lot of work to improve our processes going forward. We filed the FIR on June 29th, and it's now published on the Ministry of Municipal Affairs and Housing website. That's the earliest that it's been done since the inception of Norfolk County. Our audit fieldwork with Millards was turned around in 3 weeks, which is the fastest turnaround that we've had in a number of years. So we're working hard to clean up those things and to make sure that we can continue to bring council more financial information in a more timely manner. So we thank you very much for your time, and with that, I'd like to turn it over to Mr. O'Donnell to walk you through the financial statements.
This on, do you want to take questions on your 15-page report now, or do you want me to continue, and then we'll open it up to questions? And that's what we're going to do. Mr. O'Donnell, if you want to come forward and give us your report. Jeff O'Donnell's a chartered accountant with Allard, Rouse and Roseburg. He is no stranger here. Welcome, Jeff, and take it away when you're ready, sir.
I got that right this year. You're a good teacher. Good afternoon, and thanks for the invite again to present your 2017 audited statements. Your Treasurer's report gave a very thorough overview of 2017, as well as some multi-year data for additional information. My job is to present the auditor's report as to our opinion on the fairness of the statements, and I'll also try to complement the Treasurer's report with an overview of these statements at a fairly high level. If you have your statement package with you, our auditor's report is on the bottom of page 2. It has a little 2 in the bottom corner. I don't know if that's front and back of your pages. It's got independent auditor's report. Main goal of our exercise is the second paragraph from the bottom in the opinion paragraph, and that in our opinion these statements present fairly the position of Norfolk County for 2017. You'll notice the date, June 15th, 2018. Just for reference, further to what Amy said, the first year of the new system transition was in 2015, and our audit statement date was January 15th, 17 for the 2015 year end. Last year, for 16, it was August 9th, 17, so we did move it up. This year's June 15th, 18. It is the soonest I've been in here for quite some time. Usually it's after summer break, so good job by finance. I think it's the smoothest I've seen the audit go since I've been doing it. I'm pleased with their progress, and I think council will be happy with the type of information you're going to start to see that's more comparative, more timely, probably with some rationale and reasons behind it as to why and what we need to do about some of those things. So I'm, as a resident, very happy for that. As your auditor, my fee keeps going down. That's not good, but
It will continue to keep going
probably will continue to go
thank you.
down.
That's
Yeah.
good.
Go to page 4 if you would. On the bottom right corner again, this is your consolidated statement of operations and accumulated surplus. So I'm going to focus on the operational part, which is revenue minus expenses for the year. Your budget numbers are there for 17, and those, when you adjust what you approve to PSAB, we take out things like TCA additions, debt increase and decrease, reserve transfers in and outs. Those aren't revenue to us. Those are handled on another page. So, and our numbers on the actual side also include depreciation or amortization, which your numbers don't either. So there's a substantial difference. You don't budget for a $5 million bracket. your debt payments or increases and reserve transfers give you a zero cash flow position at the end of the year, and that's what you budget for. So these take all your funds into account: tangible capital assets, reserve fund transfers in and out, regular taxation, government grants, and all those things. The actual figures for 17 and 16 are presented. You'll notice under 16 there's a restatement note. Page 21 explains that a bit. You had an actuarial study done for your employment benefits and post-retirement benefits. It had been a number of years since one was done. He did come in and make some adjustments for the post-retirement benefits. The policy of the county prior to this wasn't offside with the rules. It was on the event-driven basis, which means you established the liability for those retiring in the year that they retired and decided to continue with the benefits. The world is moving closer to full accrual accounting, where those people earn the right to those benefits as they worked. And there's a large proportion of them that do. So the actuary goes in and say, based on what we see, those people that retired, this number's going to take it, and that's how much it's going to cost you. So they don't earn that after they retire. They earn that as they work. Accountants like to park things. It's called the matching principle. So we match that expense with the year that they earned it, not in the year that they retire. You will fund it in the year that they retire, and you've been doing that. It's not unmanageable to fund those balances. They're large. The adjustment for those numbers was about $7 million. The liability went up 7. It didn't hit the income statement this year as an expense. It related mostly to prior to 2016. So the accountants went back and we reduced the county's surplus by about $7 million on the opening 2016 numbers. So it didn't show itself through too badly, but it does show your liabilities more accurately on your balance sheet, which is what the world's looking for. I hope the province and the feds follow our lead. There's a number of municipalities who may not be doing this accurate yet. I've asked some, especially on the unvested sick leave. Your invested sick leave was looked at and it was okay. So I'm just hoping all municipalities get on side with this too. We need to be more transparent with our liabilities. Contaminated waste and all those things are coming on the radar more and more too. So we're not sure what we're in for, but we want to get the ones we know on the balance sheet on the liability side so we can cash flow for those things in our budgeting process. So that restatement that's referred to under 16 didn't change these numbers much. The thing that it changed was the second line up from the bottom. That number was for $544 million on the 16 statements. They've now been adjusted to 537, which is that $7 million hit that we talked about going back to the opening surplus. In terms of regular income and expenses, your total revenue for the year about $185 million compared to $178, rounded up about $7 million from the year before. Taxation went up 3. That's about a 3.6% increase. Government transfers went up about 3. That's largely the impact of using some of the gas tax revenues that we get. We didn't use as much last year. This year we used $3 million more. It's not that we didn't receive any last year. We just didn't have the projects in place last year that allowed us to put those funds towards because they're restricted somewhat. So we brought $3 million more of those in this year. Provincial transfers are down about $1 million, and page 18 has the breakdown of those, but it's mostly infrastructure money that the province gave you in 16 that didn't reoccur in 17. The social support and housing and all those things, those revenues are pretty much where they were, adjusted for inflation. User fees, 30 million versus 28. That's mostly your water and wastewater charges that are in there, and they're up about 4. And other income's up about 7 from the prior year, again, which is a breakdown on page 18 if you're interested in seeing that detail. So revenue's up 7. Expenses, 184 from 178, about $5 million increase. And you can see the increases. General government getting the biggest hit, up about $3 million from the prior year, 14 to 17. That's where that $2 million write-off between the counties got pushed. And that's also because of the restatement. Your 17 numbers, because of the actuary adjustment, $1 million more was put in that line for that adjustment too. Not a real hard outflow, but it is an expense in the period relative to his study. Health services went up about $1 million. Social and family services up about $1 million. Social housing down about $1 million. Recreation and culture services up about $1 million. So total, 184 versus 178, up 5. Revenue went up 7. Expenses only went up 5. Means you're going to have a swing on the bottom line of about 2, which you're seeing. Last year you had a bracket of about $1 million. Consolidated-wise, this year you have a surplus of about $1 million. So all things considered between all departments, break-even year, more or less. If you want to go back one page to page 3, that's our statement of financial position, or our balance sheet for us old-timers. Not the private sector yet. In the private sector, we have assets, less liabilities, equals equity. Here we have assets, less liabilities, plus some assets. Then we get to surplus. This also doesn't break out current versus long-term liabilities, which to me as a user, I'd like to see how much debt we're going to have to pay next year, not all at once on one line. That's broken down in a note. But I think the people who are smarter than us will probably see the light and move more towards something that's consistent with everybody else, since our accounting entries are moving towards something like everybody else through amortization. So that'll make them a little more user-friendly. In terms of assets this year, 118 million in assets versus 105, up about 13. If you add the top two lines together, your cash and investments total about 103 million this year versus 86. So they're up about 18 million. You took out new debt this year of about 19. You repaid back about 5 of what you had outstanding, so a net increase in outstanding debt of 14, and a lot of it's still sitting in the bank account. That explains the increase in cash. Why go out and get debt? Well, a lot of those investments are the reserve funds and the legacy funds, so it's not for us to touch. Taxes receivable, about the same as last year, 8.6 versus 8.2. It's up 500,000. When I look at the stats, as a percentage of your levy, that's about 12% of your levy still outstanding, about 12% in the prior year, which is down, if you look at 5 years ago, 19% of your levy was outstanding at the end of the year. The current stuff is now 60% of that total. 5 years ago, it was only 46% of that total, so it's improved. The old stuff is getting cleaned up, and the stuff we have is more current. The 3-year-old stuff this year is between 400 and 500. Well, the 3-year-old stuff 5 years ago was $1.6 million, so things are improving in that regard. Accounts receivable, 6.6 million versus 11.3. Included in there was the receivable from Haldeman County, and when we write it off, it's not. So that explains about 2 million of the decrease. We also had about $2.5 million of outstanding government grants last year that didn't get in until after the year end, but belonged in 16, so they come in and they're not outstanding anymore. Liabilities, 136 versus 120, up about 16. Main drivers of that is a net debt increase of 14 million. We issued 19, paid back 5. And deferred revenues up about $3 million. Those are things like the gas tax revenues that we have to park until we earn it. Otherwise, we have to send it back. We'll probably never send it back because we'll earn it, so I'm not worried about having to pay it out. But development charges went up about $2 million of those monies that we're holding. They'll get moved in as those developments are done, but they're not going to get paid out, so it's not like it's a liability we're going to have to commit to. We're just waiting for a few things to get done. The landfill site didn't change. We have recommended a actuarial study on the landfill site. It's on the burner for Haldeman. It's not on their near burner. I think it's more near than it was last year. So it would be nice to have that updated now that it's closed, and in particular, kind of give us an idea of the 18 million. When do we think we're going to have to pay that out, just to give us a little cash flow estimate, but that's coming. I don't know that it'll change much from there. What we've been doing on that so far is using the previous actuary study and having engineers update that under the same format as they did, but I would rather get an independent actuary to confirm those numbers for us, and we'll see where it goes. So liabilities are up 16, mostly for those two things. Non-financial assets, which include the tangible capital assets, 553 versus 550, up about 4 million. You had a list of assets that added up to about $28 million of new. We amortized $24 million of the stuff we had in the ground and on the ground. So our net increase in TCA was about 4. The bottom line is accumulated surplus. So I would like you to go to page 17. Note 10. It does a breakdown of our accumulated surplus amount. The total at the bottom is the same as we just saw. It's up $1 million from the prior year because that's what our surplus was on the year. And then we break it out into these various things. So when that gets distributed to the various funds, TCA fund, if you look at it, it's up 3 from the prior year. It accounts for about 90% of our accumulated surplus. So don't ever tell me that surplus is a dirty word, because if we hadn't earned the surplus, that would all be debt. So that's what our largest investment is in the county. The balance of the accumulated surplus is about $61 million. And that's our reserves and reserve funds compared to 62 about in 2016. So our reserves on a total basis have come down about $1 million from the year before. The legacy fund is about $67 million of that. So the bottom line is our reserves do continue to need some help. And let's go back to page 3, which is that balance sheet again. So all in all, like I said before, a break-even year for the county on a consolidated basis. The balance sheet remains in pretty good shape, all things considered. The county received another AA- rating from Standard & Poor's Rating Service. I don't think that had changed from the prior one. Debt levels have increased, but you're still well within borrowing guidelines put out by the ministry. I mean, that doesn't mean we have to get there. I think you said that, which is good. Our Achilles heel, I think, is likely our reserves and the challenge of finding a manageable financial solution to the trend in our reserves and the funding for our infrastructure. So good luck with that, and we're all in this together. Any questions of me or of finance?
Thank you very much, Jeff, for your work on this. Well done, well presented. I'm going to open it now to questions to either Jeff or staff. Councillor Black, where you go?
Thanks, Jeff, and questions, I guess, to you and staff. Said I wouldn't ask you too many, but I guess I lied.
It's an election year, be careful.
Yes, sir. Yeah, I was just wondering, like, I'm always a little bit fearful of the reserves, and we have made some attempts, and council has tried to push that forward, recognizing that we do have that problem, and we have. And over time, we'll end up building that up. But I'm sure you're aware of that, but are you saying that maybe that's not enough, that we need to do more than what we've already done? Or I could put it in another way, so I'm not asking you, I could ask James to say, now James, that you've heard what our auditor has said, are you still comfortable with kind of sitting on the plan that we have in place, or are you thinking of coming back with another plan?
Through you, Mr. Mayor, to Councillor Black, when we presented the reserve report last year, that was not an all-inclusive solution to our reserve issue. We tackled the roads reserve very well. We had a 5-step approach to put that in the black by the 10-year period. Part of that was a DC study that we're currently undergoing, and there were some other steps that we took as well. So during that report, we identified 2 or 3 reserves that we needed to increase the annual contributions to. And if you remember that one slide, I believe it was about 1.1 million that we increased on the levy for those specific reserves. We have between 30 and 40 reserve funds and reserves in our books. There are other ones that we need to work on. And there will be a report, 2 reports coming this year. One is a reserve financing policy, and the other one is a reserve, just a reserve policy where we're going to identify some other reserves that we're going to adjust and get council recommendation to fix those reserves as well. We don't have, but by far we don't have all of the reserve situations fixed. It'll be a multi-year approach in order to get where we need to be.
Okay, Mr. Mayor, thank you for that. And I do appreciate you saying that, because to me, that says that, yeah, we've taken step 1, of the plan, and I like the idea that you're planning for the future. I mean, it's easy to go, I guess it's not easy to go year to year, budget to budget, but in terms of looking at the long term, it is more difficult. And then my next question would be, would there be any advantage to having a multi-year budget in terms of capital expenditures, roads, infrastructure, whatever it may be? Right now, you know, we do it year by year. You know, engineering does the road, and so we're limited to how much engineering we do and how well we are prepared to put tenders out. So is there an opportunity to save money to do multi-year budgets? You know, and we sort of did that this year with some of the bridges. We put, I think, 3 together and tendered those out. So could we continue to do something like that and possibly save some money by doing multi-year, multi-project, multi-bids, or people to bid on, you know, multi-projects? So,
Through you, Mr. Mayor, to Councillor Black, we currently have a 10-year capital budget that we do every year, and that 10-year span changes every time we bring it to council, because things change, and it'll change again once we get the asset management policy in place. There are several steps that the Finance Services Division are doing in order to get to a very solid financial sustainability for Norfolk County. We coined the term turning a freighter quite often in our department because that's what it's like to get to where we need to be. The first step a number of years ago is the new financial statement. Years before that, our year ends were drastically behind. I believe in 1 year, we did 2 year ends in 1 year in order to catch up. So now we're at a position where we can concentrate on our financial statements in-house and provide more meaningful information to council. And next year, for the 2019 budget, is when we're planning on doing variance reporting, regular variance reporting to council. And until we get those steps done, I believe what you're referring to is perhaps a three-year rotating operating budget, which other municipalities have done. Larger municipalities tend to do that. We're just not there yet. We have other items to take care of before we get to that stage.
okay, so that's maybe step 5, and the other ones, maybe you're 3 steps away or whatever. Just a couple more questions. Wondering about the BIA audit. Like, where would you find that separated out in the audit statements? I don't know if it's done separately. It used to be, not with, I don't think it was ever done with Norfolk County, but when it was Simcoe, you had a separate audited statement for the downtown Simcoe BIA. Like, I've seen that. How is that dealt with here? Or if the BIA wanted to pull that information out of here, how would they do that?
Through you, Mr. Mayor and Councillor Black, the Simcoe BIA is consolidated with Norfolk County's statements.
So it's not separate?
It's not separate. We do have a separate statement of operations on our internal financial
okay, so that's where they
information.
get it, is through the operating statement.
Correct.
Okay, that's good. That answers that. And yeah, lastly, just a thank you for including the performance measurements. I know there was an individual that was concerned about where that sort of disappeared to, and you said you'd bring it back, and here it is. And I think it's a good set of numbers to look at to see how we're doing in terms of our performance. So I really appreciate you doing that. And lastly, just the same appreciation to Millard Rose and Roseboro for all the work that they have done in the past for Norfolk County, and getting better and better at it all the time. And how can I not say thank you when you say that your price is going down?
Thank you, Councillor Height.
Thank you, Mayor Luke. I have some questions for staff and the auditor, but I'm going to ask the auditor first so that he can sit down, and then I'll speak later on to staff. So,
Thank you.
through you to the auditor, PSAP, when were those standards implemented?
2009.
2009. So 9 years later, we're still referring to the old method because what I heard from staff was old counselors were used to that. So in that theory, old counselors are probably used to handwritten notes. So at what point will we actually do away with that old standard and use the real world?
I'd love to find a way to communicate better between this and that, and that's what you've tried to do this year a little bit. I'd encourage all of that. Our budgeting process has to be more unified, I guess, capital, operating, PSAP, amortization, cash flow, long-term liabilities. So I think it's time.
Okay, good. Me
Yep.
too, because that's painful. I've never seen anything but PSAP, so I don't need the old version, and it must be a huge waste of resources. Now, the difference, I'm having a hard time understanding the difference. You said we have a surplus of around $1 million, yet in the PSAP version, do we not have a deficit of 5.6 million?
Operating fund?
Correct.
Yes. Consolidated fund? You have a surplus. Operating fund? Had a loss of about 5.6. Yep. 3 of that is $2 million for the write-off and $1 million for the benefits adjustment. So your adjusted operating loss to compare it to last year is 2.6.
Okay, because like when I look at the figures, I see we had a 3.6% tax increase, $2 million revenue increase. Page 19 of our report says our liabilities are at an all-time high, and we're planning on taking another $43 million in debentures right here shortly. Like, how do we turn that boat around?
Let's get back to Peter's question. I think we're going to find we have to pay more to live here. I don't think we're going to have a choice. Try to run it for less and it won't work. I think in the meantime we fall a bit behind. So fun with numbers. Okay. I think we're paying too little. I think the province and the feds have to do the same thing somewhere along the line, but efficiencies enter into it. You don't pay me enough for that.
Okay, now, I know you don't have our report, you have yours, I believe, in front of you, but on page 20, which was table 7 of the staff report, it says here, accumulated net surplus. Our unfinanced capital is massive over the past 4 years. It was, 24.5 million in 2015, 29.9, 2016, restated at 29.9, and then 16.5. What's happening there? Before then, the highest it ever was 7.4, or 7.7, sorry.
This is your unfinanced capital?
Yeah.
That's your work in process? You have more capital projects in process than you did years ago, I guess, at this time of the year.
Right.
Yeah.
So that's what it is. We're not being able to afford the capital projects that we have.
Oh, I think you're building them. You just haven't funded them yet. As soon as that gets into capital, you're going to have to debenture and/or pay to balance that off.
Okay. Now, on page 40, table 10, a second. There's the unfinanced capital again, and if you go down, we also have unfunded liabilities, to tune almost $24 million altogether. That's an awful lot of money. Now, is that what you spoke of earlier with an actuarial study for the landfill? Solid waste landfill liability, 18 million?
Yes, those are liabilities that are going to have to be paid. It's just we haven't set aside any money to pay for.
Okay.
So, like I said before, if you're paying $500,000 a year for the landfill, I don't know that you have to reserve for it. You just got to come up with the $500 a year. Mm-hmm. Same with the post-employment benefits. You've been funding those for a year out of cash flow. You haven't parked any there, so you don't have any money waiting to pay it. You just pay it out every year as it comes due.
I see. Okay, so in that actuarial study will give us more solid figures?
What to work toward? What you're in for? Yep.
Okay.
Yep.
Okay, and so is that something we should bring a motion for, or is that something that staff is working on
Which one's that?
to get that actuarial study done?
It's done.
It is done.
For the post-benefits? Post-employment benefits?
No, for the landfill.
Oh.
Landfill's 18 million, the post-benefits are peanuts compared to that.
I think you have to run that with Haldeman because you share responsibilities of that. It has been on their audit recommendation letter for several years. They did an actuarial study on their workers' compensation and employee benefits about 2 years ago, and they're going through the same change, I think, this year on the computer side as we did 2 or 3 years ago. So I think it is on their burner on top of everything else.
Okay,
Yeah.
Thank you.
If you want to put in a word
I
in
will.
terms of council saying, when are you going to do it? That's a James thing probably to Mark
Yep,
and let council know.
I'll get to that, thank you.
Okay, thank you. Councillor Brunton, please.
Thank you, Mayor Luke. Thanks, Jeff, for your report. Staff, I have some couple of questions for both, I guess, but first one, did you bring any money with you?
Yep.
No.
Yep, $20.
Um,
I need a receipt.
My question, I guess, was answered with the PSAB. You say you'd like to see us using that as a,
Well, it's very difficult for us to get from our numbers here to kind of what you guys see regularly. So it's go ahead, James. Yep.
Through the mayor to Councillor Brunton, probably the most difficult thing to do to join what we budget for and what PSAB displays is the amortization of the assets. We don't budget for that. We don't tax the local residents for our amortization expense. And so that's a challenge. One option we do have is to try to have the amortization expense as our contribution to the reserves and match those. But we're a ways off in order to put those things together.
Jeff, you indicated that you'd like to see us increase our reserves, and I don't disagree with you on that, but I also see, I'm not sure, but I think 4 years ago, if I remember, our capital per year was substantially higher than about the 38 million we had in 2018. I agree with the increase in the reserves, but I also like to see a change in how we look at capital, and I've suggested for some time I'd like to see more local improvement. We seem to just go in and spend money all over without really, how do I put it? If somebody, like I live in the country, I live on a tar and chip road. I don't expect to get curb and gutter and water and sewer put into my house. I bought under those conditions, so. And I tend to see that happening all across the county. It's good, but it's costing us money, and to me, that's where a lot of our debts come up in the last 4 years, and prior. So, anyways, just a comment. Can you tell me on page, and I don't recall, what was the $2 million write-off in FS 1832? What was the write-off of $2 million? Is that the Haldeman issue?
Through the mayor to Councillor Brunton, yes, that was the shared cost with Haldeman dating back to 2001. It was 2.1 million and change.
But we are getting a check from Haldeman, are we not?
Yes.
For how much?
There will be revenue recognized in 2018, and you'll see that on your financial statements is 678,000 was the principal, plus interest on that investment.
I take you agreed with the 2.1 write-off, whatever it was. Okay. My question on, I do like the performance indicators. I really appreciate them. They show a lot of good information. But is it, you mentioned our tax arrears are about 12% in 17, in your calculation?
Our outstanding receivables are about 12% of the total levy.
Okay, all right.
And it's comparable to 16. The number's higher, outstanding, but our levy's higher. So relative to that, the same percentage is outstanding this year as it was in 2016. Sometimes when you see an increase, you say, oh, that's more outstanding, are we in trouble? It's just larger because the number's larger.
Correct.
The aging has improved over the
I'm
years.
not sure what the levy was.
About 80, right?
80, we were 84 this year, you know, so. Is that, would you call that acceptable, or you'd like to see it a lot lower, of course, but,
I think as long as most of it's a year or under, I don't think that's bad at all.
okay.
We don't study aging across the province of municipalities. Your talk some time ago, David, if I can get to that, was the first time I'd heard comparisons at that level to other municipalities. We do audits. We don't compare levies and rates and stuff and the aging of receivables, right?
Okay. On page 12 of our report, it gives a breakdown, and at the bottom, right at the top on table 1, it shows other minor amounts, 6.4 million. What is in that? I wouldn't call it minor. Is that where we borrowed money for air tanks or debentured the air tanks for the firemen, things like that? Are those kinds of things that go into that?
Those are just smaller dollar capital assets that we haven't called out individually that were closed this year, lumped together on that
Can you
line.
give me an example? That's a lot of money, 6.4 million.
I don't have that information in front of me right now, but we can get that information back to council.
Okay, all right. And on the, I'd appreciate that. And on the, find the other ones here I highlighted. Page 20 of our report. Reserve and reserve funds, well, I guess, maybe to Jeff, without the legacy fund, I would say things don't look that great. Is that safe to say?
Yep.
Thank you. That's all I have. Thank you.
Any other questions? And I know I have one for Jeff, and I'll get back to you for staff. Jeff, just one for you. On your page 14, the long-term liabilities, in other words, our debt, has risen substantially from last year. We're at about $60 million right now, correct? And a couple pages back on page 11, we see our investments, which I will call cash, 95 million. So, you know, people tell me we're too far in debt, but they forget that we have some more than that just sitting in cash invested. I guess, you know, that's a debate or a conversation you can have, and everybody has a different idea. So I guess on the $60 million currently, and you show back the paybacks, the principal payments over the years to keep that down, where would you say our threshold is as far as a municipality with our debt load? Is 60 million, can we go, I think the province says a guideline, we can go to about 120, about double that? Maybe that's a question for the treasurer, not
It is.
you. Mr. Johnson, do you want to comment on that? I know that there's a guideline of where the red flag goes up.
There's several guidelines. The one that we refer to in the FIR, in the Financial Information Return, the province says that you can't go over 25% of your operating revenues. Right now, we're at 5%.
5,
Yes.
and we can't go over 25.
You can't go over 25.
Okay, thank
However,
you.
I caution that. It's like your bank going to you and say you can borrow up to 40% of your gross income. You may not want to do that because then you can't pay for anything else.
I'm not
So,
suggesting we go higher, I thank you for that. Anything else for Mr. O'Donnell? And if not, I'll have him take a seat. Mr. O'Donnell, thanks again, and for all your work on this, and we've in pretty good shape here in 2018 is reporting our audited statement, and you along with staff have done an
Oh, they did a great job.
excellent
Yep.
job in getting us where we are. It's taken a while. There may be more questions.
Yep.
We'll get you back if needed.
Thank you.
Councillor Height, if you wish to continue with staff, you may.
Yes, Mr. Mayor, thank you for that. Through you to